Trend lines are a super common trading concept. They're used by hundreds of thousands of traders around the world, but they're actually not the best if you trade them in the usual way. Now, in this video, I want to show you a new way to trade trend lines in line with some other price action concepts so that you can turn your results around, stop losing with trend lines, and instead start understanding what they're showing you and getting some really great trades as a result of that new clarity. So with that said, let's get into the learning. What is a trend line then? Well, a trend line is just like this line that we've got drawn on the chart. There are two types of trend lines. This one is an ascending trend line or a bullish trend line. Now, the reason it's ascending is because the market is moving up. And basically, to make this trend line, we just connect multiple lows on the chart. So we have 1, 2, that is our trend line. And then the theory would be we have two ways to trade it. So number one, the simple way, if price retests this trend line, we buy, expecting the market to continue higher. Number two, if the trend line breaks, then we sell a retest of the other side, targeting previous lows. Now, this is not how I trade them, but this is the common way to trade them. I'm going to show you a better way today that's more accurate. Now, the other type of trend line is a descending trend line. This is when the market is moving down. And instead of actually marking out the lows, we're marking out highs here. So we have a high, we have a second high, and then anything past the second high, we would look to sell a retest or buy a break retest if that happened instead, okay? So that's the general theory of how people trade trend lines. We have ascending, which is an uptrending move, and descending, and the theory behind them is simply to tell us the structure. Which way is the market going? Well, this one is showing us the market's going down, and the other one showed us the market's going up. So the first problem I have with trading trend lines is subjectivity. They are subjective, which means we can draw them on in pretty much any way. Now, take a look at this. We have one low, then we have a second low here. So we could use this as a trend line. But before that even formed, we might be 1, 2, like this, okay, this low and this low. Now, they're so subjective that it makes it tricky to work out where a trend line should actually be. You're pretty much always deciding for yourself where the trend line goes, which means you can kind of bend the narrative to fit your personal biases. That means it's not a massively accurate way to trade. Now, the second is there is no logic behind them. They don't really exist. It's just a line that you've drawn connecting lows. There's no real specific reason why the market should retest this level. And if it breaks, there's also no reason why this should lead to a reversal in price. So there's actually no logic behind them, which is why they rarely ever work out. So the whole goal of a trend line is to tell us whether a market is going up or down. But structure is read by looking at lows and highs in the price. Now we could take a look. This would be our low. Then we have a high at this level. Then we have a low at this level, which would be known as a lower low. Then we have a high at this level, which is our higher high. Then we have a higher low. And then we have a higher high, okay? Just here. So realistically, looking at this market, the structure looks like this. The trend line doesn't actually tell us about structure here, because in order to change the trend, we would need to break from higher highs and higher lows into initially a lower low, which would mean we'd need to see this level here broken, right? If we wanted to see a reversal in the trend, we would actually need to see that structure change. This is where one of the biggest problems with trend lines comes in, because if the market breaks under a trend line, some traders will here start looking to sell, thinking that this indicates a change in the trend. But if we look at the actual structure, with the low being here, as we've marked, there is no break. So even if we come through the trend line, we can easily continue trading higher because the market's still making higher highs and higher lows. This is probably the biggest problem with trend lines. Now let me show you this. If we run the market forward, we see, first of all, a trader who bought on the trend line here would have lost the trade because the market broke through. Then they would have been tricked into selling because we got a break. So then they would have entered a sell here and they would have lost that too because the market continued going higher. So the trend line actually caused 2 losses if you were to follow the rules of how to trade trend lines. Now, if you've traded trend lines before, you probably understand this happens a lot. Now, if we remove the trend line completely and we just focus on the structure like we did, well, we can see now nothing actually changed. All we did was form a new higher low and then pushed up to form once again a new higher high. So from a market structure price action perspective, the trend has stayed completely intact and has been an obvious buy all the way through. So there's no opportunity for us to get lost here and take multiple losses because we're actually just following the simple market structure. So those are the biggest problems with trend lines. Now I'm going to show you how I trade them instead and explain a theory called liquidity. Let me introduce the concept of liquidity. Liquidity refers to orders or money. And the markets move simply because of orders and money. transactions taking place on the buy side and the sell side. Now, when a market is going up, it simply means there is more buying than selling taking place, which causes a discrepancy between buy and sell transactions and causes price to increase. When a market is going down, we see the opposite. There's more selling than buying taking place, so prices have to decline to reach levels where buyers will be happy to buy once again. Now, because markets react to transactions, to liquidity, to orders, to money, we're going to see considerable reactions from areas where there is a lot of liquidity or a lot of orders, a lot of money. Now, if we consider how this trend line works, it doesn't really mean anything. It is just a line that we've drawn on a chart, right? There isn't really much logic by this. And this is why, as we've just explained with the structure example, these trend lines can break and then still continue moving upwards, or why they can bounce and then still fail. Now, one interesting piece of information surrounding liquidity here is that we are going to have a lot of buyers on this level. We're also going to have a lot of sellers once this level is broken, which means we have a lot of orders. We have a lot of stop loss orders down here, which act as buys. Okay, so they are sell limits for buys. Now, if we think about the fact we're going to have a lot of buyers entering at this level, what are we going to have then? Well, beneath that, we're going to have a lot of stop losses, okay, and also sell stops from breakout traders looking to get into shorts if the level breaks. So this is our first area of considerable liquidity, where there's a lot of orders waiting, sell stops and stop losses for buys. Now, looking the other way as well, we have more liquidity. We have sellers here, which means there is going to be more liquidity at this point. This is where we get the buy stops for traders looking for a break back above, or we have stop losses for anyone who's selling beneath this low. From a liquidity perspective, we have liquidity down here, we have liquidity here. These are considerable amounts of liquidity. Now, if you know anything about liquidity, you might have heard people talk about it as kind of traps, okay? As if institutional traders are trying to bring us into position so they can purposely make us lose trades. This is not really the case, because retail traders like us and smaller commercial banks, we don't have the liquidity that is really going to drive the market. And it means nothing for an institutional participant to actually get us taken out of trades. However, because markets do react to liquidity, and because they do react to areas where lots of orders are placed, and they don't react to areas where there are less orders, like in the middle of a range. For example, here, people aren't really trading too much in this area because people want to buy from highs and lows. So because all the liquidity is here, this is the area where there's most likely going to be a market reaction, okay? Underneath the trend line, where we have people getting stopped out and new people getting in mass. So there's a huge amount of orders sitting under this level. Now, because of that, markets will just naturally grind their way down into that area. There's not enough transactions to reverse a market in this point, but there may be down here, where people will be pretty much getting stopped out or getting into new positions. So if we have a load of orders here, this allows people to take the other side of those positions, right? Which means if the market breaks into this region, there's a huge amount of liquidity freed up. Everyone who was in a buy trade has to sell their contracts back to the market. And everyone entering a sell trade is obviously selling more contracts to the market. So there's a massive amount of sell positions opening up here, and people can take the other side. Now, if you wanted to get on a large buy position and you didn't want to have a staggered entry, basically meaning if you enter a huge trade, sometimes you can momentarily drive the market. So you might end up getting one entry here, one entry here, one entry here, etc. If you just wait for an area where there's a mass amount of liquidity available, then you can actually use that liquidity to get into a clean buy trade, which is why, as you can see, after this push down, after trading through this level, we had such a strong, clear, uninterrupted buying move here. As you can see, just bullish candle, bullish candle, bullish candle, bullish candle, pretty much no rejection or pushback from the sellers. So that's going to become a strong move formed from the fact that so much liquidity was freed up here that institutional participants, larger traders, commercial banks are looking to get into larger positions, and they get into a large buy-side trade because the amount of liquidity from tens or hundreds of thousands of retail traders opening positions at this exact level, right? If you've got one retail trader opening a sell, then it's going to be hard for you to buy hundreds of millions of dollars of an asset against them. But if you have 10,000 traders opening a sell here, well, that's a lot more liquidity because you've got 10,000 trades worth of money ready to take the other side, okay? So it's not so much that you're getting caught in a trap or forced to do this, and it's not like the sadistic commercial banks are trying to upset you by getting you stopped out of your trades, but it is just the natural flow of the market. Markets will react to where orders are, and that is down here. So this pretty much answers the question as to why trend lines do what they do. But now we're going to move on to another concept, and I'll start showing you how we can actually trade these successfully. So by this point, I've explained to you why trend lines are not super accurate. and I've showed you why they likely get swept and why they often do actually fail to provide winning trades and instead get you caught in a trap on the buy side and then a trap on the sell side. They're not the greatest things to trade, but obviously understanding what we now know about liquidity, where markets generally sweep these levels, surely there's got to be a way to trade them, right? And you would be right. First things first, we want to consider the structure that we've already looked at. So we want to make sure we're following the market by looking at the highs and the lows. And if the market is continually making higher highs and higher lows, we want to buy it. If it's making lower highs and lower lows like this one, then we want to sell it. So we can pretty much disregard the trend line, and all we actually have to be focusing on is that initial structure. So I'm just going to quickly plot on these highs and lows. So up to this point, we have our low, a higher high, higher low, higher high, higher low, higher high. So we can disregard that trend line. This is really not going to tell us a whole too much. Instead, we're going to focus on that direct structure with highs and lows. Now, the next concept I want to introduce is this one here, supply and demand. Supply and demand is a concept where we find areas in the market where significant buying or selling took place before, and we can use that as a guide to understand where buying and selling will take place in the future. So, you've seen I've just plotted on a little box here. This is what we call a demand zone. Now, the reason this is a demand zone is because this is where we've seen demand enter the market before. Demand is just a willingness or want to buy an asset. When demand is high, prices go up because anyone holding the asset can now sell their asset for more because people want to buy it. They're happy, they're willing to pay higher prices. So, how do we know this is an area of demand? Well, if we look back here, what we've seen is a consolidation just in this area here before a large upward move in this market. So the consolidation area that we've got marked here becomes our demand, right? This area here, or this area here on the real chart. Now, because we've seen a lot of buying coming from this level, it tells us something. It tells us this has been seen as a discounted price to buy this asset from retail traders and institutional traders in the past, primarily institutions, because we're seeing market driving movements, which generally indicates that this is where institutions are entering the market. So because this has been seen as a discounted price, we can see over here to the left, we're looking at around 1.26500, 1.26800, 1.26200, somewhere between this range, okay? Any of those prices were seen as a discounted price to purchase this asset previously. If you have a price that is seen as a good price for an asset, and then price gets more expensive, where are people going to want to buy? They're not going to want to buy at these expensive prices up here. They probably don't want to buy on the way down either. Instead, they are looking towards this discount price, okay, this discounted price area, which is indicated by a demand zone. Now, when this demand is hit again, like this, we would be pretty sure or have a pretty solid idea that providing the market structure stays intact, meaning this higher low doesn't get broken, and providing that we start to see some nice reactions from this demand, well, then this would be a good place to see a new influx of buying, right? Because it was a discounted price to buy from before. Now the price has creeped even higher. It becomes an even more attractive point to buy from if the market returns to it. And as we can see, after getting this push away, we get a pullback down towards this demand. And when we hit the demand, we get this huge rally to the upside. Because what we're seeing here is a new influx of buys taking place from what has already been seen as a discounted price to purchase an asset. So now let's overlay that trend line and you'll see that it's not too useful, okay? But I did say this video is how to trade trend lines. So why am I now taking us away from trend lines and showing you a different system? Well, the trend line is still incredibly useful because trend lines are how we're going to identify the first ideas for these trades. Now, if we draw the trend line on the chart, that is going to give us a general idea as to where reaction points could be. So I've cleared everything off the chart now and the market is trading back here. The first thing we can do in a market, which is incredibly simple, is just draw some trend lines, right? If the market's going up, connect those lows. Now we can use those concepts of market structure and supply and demand to look into this idea. Is there an opportunity for that trend liquidity to be taken, so this area to be traded into, and if so, where would the trade arise? So we draw a trend line simply to see what the majority of retail traders are seeing. And from that, we can reverse engineer a more realistic and higher probability setup using those other concepts. So we use the trend line to see what everyone else is seeing, and then we use our other systems to understand what may be likely to happen instead, which in this case is going to include the demand. It's also going to include the trend reading. And now, from just identifying a trend line to get an idea for what everyone else is seeing, we've managed to formulate a new idea. we say, okay, there's definitely going to be trend liquidity in this area. This is where traders are going to be buying and selling in mass, but we've got demand below, and we've also got a clear uptrend. So instead of going for the trade like this, the obvious trade that most traders are going to be going for, we're going to sneak through, and we're actually going to look for the long opportunity to buy from demand. Now, how would we line up a position here? Well, generally for a setup like this, if we are looking at a demand zone, we are going to buy the demand. Our stop loss would go beneath the low, and then our target would continue into either the previous high, or if you wanted to, you could push it further. But this is the most simple format that I'm going to show you to begin with, okay? Now, the reason that we set up a trade like this is, what did we say about market structure? Well, we said if structure changes, the trade is wrong. So this is our higher low at the moment. Now, if the market breaks through that higher low, then the trend line might very well play out quite well. We would generally then see a pullback and a sell, because we've actually seen a change in the structure from the higher highs and higher lows into a lower low, which is generally going to be followed by a lower low and a continuation lower. So if we put our stop loss underneath that level, well, now there's no reason for us to be wrong on this trade unless the market completely changes. And if the market structure completely changes, that will invalidate this setup anyway. And it's really not a trade that we would want to be getting into. So stop losses go beneath the low. And then why would our targets go up here? Well, that's pretty obvious. If the market is uptrending, we can get in and we can get out when the market makes a new high. Or if you have reason to do so, you can look to continue it even higher. But generally, your risk reward is going to be 3 or 4% for every $1 risk, or sometimes even more on a trade like this. So it's a very simple way to trade these trend lines and get solid results with a more logic-based approach that gives you more clarity and confidence and better results long term. So that is my unconventional way of using trend lines to get better results than the usual break and retest methods of trading them. Now, if you want some guidance on building this into a successful trading system, check out the link at the top of the description, take you to my free course called 7 Steps to Profitable Trades, where I help you to build your first winning trading strategy. And if you don't want to do that, then just check out this video next. I'm sure there's some value in there for you. Thank you for watching, and I will see you in the next video.